I'm Charlotte McLeod with the Investing News Network, and here today with me is Jeffrey Christian, Managing Partner at CPM Group. Thank you so much for joining me today here at PDAC. Great to see you.
Yes, it's good to be here.
Yeah, it is good to be here.
It's great to be back in person.
Yes, it is. And how are you finding it out on the floor? Because I've kind of been trapped on this stage.
There's a lot of positivity. I mean, there are a lot of people walking through. There's good foot traffic. I'm not sure if they're active investors or if they're voyeurs, but there seems to be, a fair bit of what we would call realistic approaching these different companies to sort of assess who's out there and what they're doing.
Yeah, okay, that's good news. It has been a little bit of a rocky time out there in the stock market. I think on Friday we had the inflation data come in hotter than expected. What points would you pull out for people from that?
Well, there are several points that we keep making. One is that, what we're seeing right now in terms of inflation and interest rates and overall economic condition are radically different from what happened in the late 60s and 70s. And people who are saying, well, this is like we're headed toward stagflation, we're headed toward hyperinflation, really, first off, they're wrong. But what happened in the 70s is not necessarily applicable as a model for what's happening now. We are 14 months into a period of high inflation. If you go back to January and February of last year, inflation, US CPI, was like 1.6, 1.8%. It only started rising in March, and it really has only been high since April. Now, it is a problem, and we're now at 8.6%. And we've been at high inflation, 5 to 8%, 5 to 9% for 14 months now. But if you look at the 1970s, we were at 5 to 14% inflation for 12 years. And those are radically different 12 years. That was a period of time, most of which the Fed was targeting interest rates instead of inflation, which is why we had inflation. We have to keep interest rates low. And Paul Volcker came in October 79 and said, no, we're going to target inflation, which is 14%. And we're going to get rid of that by jacking interest rates to 21%. And he did, and he threw us into a global recession and an international debt crisis, and he killed inflation until last year. So it's a radically different situation. It's not hyperinflation. Economists talk about hyperinflation as being 50% a month. We've never seen that in the United States. Even in the 70s, it was 5 to 14%. Second thing is 21% interest rates. We have seen interest rates go from 1 to 3%, 3.6% to this morning. Okay, that is a far cry from 21%. And so the Fed has the scope to raise interest rates further to try to sop up some of the inflationary pressures. It's got a long way to go before it gets to the point where interest rates are so high as to precipitate a recession. Now, the Fed has a problem in that raising interest rates and sucking money out of the economy by not buying bonds, that quells the inflationary pressures on the demand side of the economy. But a lot of the inflationary pressures are coming from the supply side, which doesn't respond to higher interest rates and less money, and in fact sees higher interest rates and raises its prices because that is raising the cost of them making their products. So, the Fed can't control the supply side, and the Fed has no control over fiscal policy, which has been really the hyperinflationary or the high inflationary pressure cooker over the last 2 years. The Fed has, since Paul Volcker, the Fed has regularly gone to Congress twice a year for the Humphrey Hawkins talks and said, look, you have to get your fiscal house in order. The Fed can stanch the bleeding during a recession with monetary policy, but it's fiscal policy that makes a stable, healthy, long-term economy. And it's the fiscal policy that has been broken terribly, really since the 1980s. And since the 1980s, the Fed has been saying to the Congress and the administration, you have to fix the fiscal policies. And the Fed has no control over that, which means that the Fed's monetary policy can only do so much to quell inflation pressures, because most of the inflationary pressures are coming from fiscal policy and the supply side of the economy.
Okay, so lots of things to pull out there. I think the first one I'll go for. So you are very right. People are making those comparisons to the
Right.
70s to the 80s. Do you have a decade or a time period that you think this is more similar to, or are we just in a unique situation right now?
I think we're really in a unique situation. There are certain parallels that you can draw to the 1920s, and there are certain parallels you can draw to the period, say, 1900 to 1905. But, to be fair, those were radically different global economic, financial, and political times. We were on a gold standard in the earlier period. We were on a gold standard with the pound sterling fixed to the price of gold and everything else fixed to the pound sterling. In the 20s, we were on a gold standard. Radically different times, radically different economic environments. Yeah, I mean, this is actually quite different from really where we were in the 70s and 80s, even. And, you know, even actually up to 2008. So when you look at people keep talking about the inverted yield curve, and they always say very clearly, the inverted yield curve corresponded with a recession every time from World War II to 2008. They don't go beyond 2008 for a good reason, right? But the reality is that correspondence was, well, you'd have an inverted yield curve either somewhere between 2 years before a recession or 2 years after the recession. So it's not a good metric. It's like, hey, honey, I'm going to divorce you sometime in the next 4 years. So yeah, it's just not a good thing. But 2008, 2009 changed monetary policy and monetary affairs in fundamental ways. And the inverted yield curve that we're seeing now isn't caused by the same factors that the inverted yield curves were caused by in the past. So it's really not even representative of anything or comparable to anything prior to 2008.
Okay, and the other thing I wanted to ask you about, so yes, we do hear all about right now the Fed, what is the Fed going to do? We hear less about the fiscal side. So I wondered if you could talk about that a little bit more and what you would want to see or what you think, the Fed wants to see there.
Well, the Fed's going to raise interest rates, and they have the scope to raise interest rates and to cut back on their balance sheet, which sucks money out of the economy. And they need to do that. And, let's be honest, a lot of the inflationary pressures have been that excess money so you have investors who have filled to the brim with stocks and bonds, and now they're buying up houses and squeezing out real homeowners, and you're moving to a rental economy. This is terrible, and the government is doing nothing to stop that. It's not a Fed policy; it's a fiscal government policy, and the government's doing nothing to do it. And you have to understand, Steve Mnuchin, before he was Secretary of Treasury, he was a vulture in the mortgage market. Buying up all these foreclosed houses, renting them out under deals that were totally unworkable for the homeowners, taking their money and then evicting them. So, you've got people in government who say, no, we're not going to get rid of what we're doing here because we personally and our friends and family are making fortunes doing it. So you have real fiscal policies that could be fixed, but you have no political will either in the government or in the voters that vote those guys in.
Right. So we talked last time about recession, and you said, yes, we could have a recession coming, but not now, maybe 2024, maybe 2026. And I wondered if we could talk about, the outlook for gold, depending on how far away it is. Does it change what happens to the gold price if we're waiting longer?
Yeah, I think what happens is that the gold price probably goes higher later if the recession shows up later, because we have a lot of very big structural imbalances, fiscally, monetarily, economically, politically. And the longer those things go unresolved, the worse the resolution, the riskier the resolution will be. And so, and to be honest, we've had a lot of these problems for 40 years now. So they just keep compounding. They keep getting worse and more intractable. They are solvable, but again, you need that political will.
Right. And, I also remember from the previous time we were talking, you're expecting weakness in gold and silver prices, most likely over the summer months. So
it's obviously summer.
Yeah. So, which of course we're used to that. But I wondered if you could talk about, how should investors approach that scenario as we're going into this doldrums time?
Well, our view is that this is a good buying opportunity for long-term investors. If you're a short-term investor, it's a great time to buy puts. you know, but frankly, we were looking at gold possibly going down to 1780 or 1750. We were at 1809 this morning, so we're kind of almost there. Puts still might make sense. Calls might make sense too. Our expectation is that the prices do rise beyond September, October, and initially modestly, and then possibly stronger later. And the same is true with silver. We were looking for silver to fall possibly as low as $20 an ounce, and we're below $21 this morning. So we're kind of down at that bottom. That said, we're in the early part of the summer, so we still have several months there be weakness. There'll be weakness for seasonal reasons in the fabrication demand. There'll be weakness because of rising interest rates. There'll be probably weakness because as interest rates rise, any number of investors are going to start saying, okay, inflation could actually come down. And because inflation is measured year over year, and you had high prices already in the summer of last year, as the CPI numbers come out for later this year, the second and third quarter, you've already seen this in the last 2 months, some dissipation in the year over year increase in prices. Now you've got some big unknowns like the US political situation and the Russian war on Ukraine and how that resolves and what might happen in other parts of the world, and some political disunion issues in Europe. So there are a lot of issues that could upset that scenario. And that leads to a lot of uncertainty, which leads to volatility, which leads to prices spiking lower, then spiking higher the next day, and then spiking lower the next day. And you should expect that. From a long-term investor perspective, this is probably a good place to accumulate. But I would caution investors to buy gold and silver if they're long-term investors, not to buy them with the expectation that gold is going to $10,000 and silver is going to $700, because those are unrealistic expectations. And I was thinking about a old friend and client of mine who I used to see every year at PDAC, and starting in 2000, he kept saying that gold was going to 10,000, and he's probably still saying that. But a realistic view is, okay, gold could go back to 2,000. It could go back to 2,100. Ultimately, we think it goes even higher over the next 5 years or so. But I think investors have to have a realistic understanding of what gold does for them as an investment and a realistic expectation for prices. They shouldn't be expecting, Jamie Dimon 2 weeks ago said there's a hurricane coming. We don't know if it's a standard run-of-the-mill hurricane or Superstorm Sandy, but there's a hurricane coming and everyone should be prepared for it. The gold marketeers immediately said, Jamie Dimon said the world's going to collapse. Now, I have a lot of friends in Florida, and they have survived dozens of hurricanes, sometimes several in a year. A hurricane is not the end of the world. In fact, some of my friends when we were younger would have big parties on the beach when a hurricane was coming, and especially if you were in the gold market. So there's a big difference between there's a big storm coming and it's the collapse of civilization as we know it. People should be preparing for a big storm coming, not for a collapse of civilization.
Okay, I think that's a great distinction to make. Very good. So as we wrap up, I have one last question. I know as CPM Group here at PDAC, you're going to be doing a manganese reception. That stood out to me because I think we know you best for your precious metals coverage.
Right.
So what's the opportunity that you see in manganese? Just briefly.
The opportunity in manganese is actually not in manganese metal, but in high purity manganese metal and high purity manganese sulfate. High purity manganese sulfate is used in batteries for electric vehicles and electricity storage systems. And what you've seen, if you go back 5 years ago, people were talking about lithium ion batteries that had 60% nickel sulfate, 20% cobalt, 60%, 30% cobalt sulfate, 10% manganese sulfate. Then they went 60, 20, 20. Now they're going 60, 10, 20, 30. So what you've seen is the cobalt market subsided because people realized, we're going to use a third as much cobalt as we thought, or less. But the manganese market is starting to pick up. But when you hear it, it's like, oh, it's not manganese metal. 90+% goes into ferroalloys and steel manufacturing and specialty alloys. It's this high purity manganese sulfate. That's where the money will be made, and that's where the supply pinches will come. And so we're having a reception sponsored by several of our clients who have been buying research and consulting services on high purity electrolytic manganese metal and high purity manganese sulfate since 2010.
Very interesting. Okay, so we'll wrap it up there. This was great. Thank you so much for coming by to talk about what's going on in the market. It's always great to see you.
I'll just say one thing.
One more
It's
thing.
not just manganese. I mean, we follow all sorts of commodities, and the more obscure the commodity is, the more interested we are. So we do uranium and tungsten, and a variety of other metals.
Okay, well, you let me know if you ever want to go through those ones. We can expand beyond gold and silver as we usually talk
Okay.
about. Okay, well, great to see you. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Jeffrey Christian with CPM Group.